Well, all the action is somewhere else at the moment, which is always a bit of a relief. The Chinese government today suspended the two biggest listed securities firms from lending any more money to their clients, which acted like a bucket of cold water on the Shanghai market, which was the intention, of course. Speculators ran for the exits, fearing that speculators would run for the exits. The Shanghai Composite Index had been up 65% in 6 months, so plenty of debt-fuelled speculation has been going on there. Meanwhile, in Switzerland, companies and their investors are still reeling from the 20% currency revaluation last week, after the central bank gave up trying to peg it. Money is flooding out of Zurich and Shanghai and into the relative safety of Frankfurt, Tokyo and Wall Street. And, it turns out, today, investment bank Macquarie Group, which lifted its profit forecast by 20% and saw the share price jump more than 5%. BHP and Medibank Private also went up, but the banks and Telstra went down a bit. The Aussie dollar was flat against the US dollar, but up against the euro, and it's worth pointing out that while our exchange rate used to move pretty evenly against all the others, that has ended. This chart shows the Australian dollar against the US dollar, euro, yen and pound since the start of last year. First 6 months, all together. Second 6 months, all over the place, and in particular, up 8% against the euro and down 8% against the greenback. And the big issue facing the world's central bankers is the lack of inflation and outright deflation in some places. An early read in Australia for December shows zero inflation, and in Europe and America prices actually fell, mainly because of the falling oil price, of course. On Friday, oil jumped, though, in New York and kept going up in Asia today, while precious metals and base metals all went up as well. And that's finance.